So I appreciate you spending a little time with me today. What I want to do is to take you through a strategy that I think is a very simple strategy. My focus really is on people who either are just beginning trading options and want a good, strong starting point, as well as people who are maybe experienced traders, but they need to push the reset button, go back to the beginning, and kind of relaunch their trading business. So my focus is all on the art of trading, how to simplify your trading and grow bigger profits. I've been trading for over 30 years. First 20 years of that was as a hobby because I had a very busy, active career as a senior executive with a Fortune 500 company. But I traded as I worked. I found ways to integrate my trading into my work, and so a lot of the trading that we teach at Options Moneymaker is designed to accommodate people who have very busy lifestyles, have busy family lives, have businesses that they're running, or have a busy career. So in just a small amount of time commitment, you really can learn how to trade. I've been teaching for the last 10 years, and I founded Options Moneymaker in 2009 to formalize teaching traders the art of trading. I really got started with this because when I left my job after 26 years, a lot of people asked me what I was going to be doing, and as I explained to them what I'd been doing as a hobby and I was transitioning that into my full-time income generation, more and more people were asking me how they could also do that. So it just kind of evolved into this passion I have for teaching others, something that I've had the benefit of learning throughout my life. I am an active trader every day. Not only are we coaching and teaching, but myself and my team, we host a live trading room every day, so we're actively engaged in working with traders and really helping them identify trends in the market and identify good potential trade opportunities, as well as the right strategies to use. And when I say the right strategies to use, they're the strategies that we favor, that we have tremendous success with, and they are the strategies that we teach at Options Moneymaker. We work with experienced traders who are perhaps active traders, day traders, full-time traders, and we also work with what I call casual traders, who are people who might have 15 minutes to an hour in a day to devote to some learning, to devote to some trading activity, but they have a desire to learn how to win trading. So we work with all levels of traders. The key success factors to winning consistently are to keep things simple. Now that seems like an overly simplistic statement, but in trading there's so many ways to make your trading overly complex, and so we really strive at trying to keep things as simple as possible. Trade a strategy that you're comfortable with. Learn and immerse yourself in a particular strategy. Generally, traders who are looking for the flavor of the month and they keep changing their strategy every month are not the most successful traders. When you really hone in on a particular strategy and become intimately familiar with all the nuances of that strategy, that's where you're really going to drive the greatest degree of success. Use a strategy that has variations that can flex to any market move. Some strategies are very rigid, that when you open a position with a declining bias to it, because that's what you identified through your charting software or your view of the market, and all of a sudden the market reverses on you, it may not be as flexible. So we promote strategies that have some flexibility to them and allow you to adjust to shifts in the changing market, which recently has been particularly important leading up to the presidential election. Post the presidential election, there were some surprises for many, many people, many analysts, as to which direction the market was going to move. So it was an additional validation of our flex approach. I also strongly, very strongly advise that when you're trading options and when you're first learning how to trade options or any other type of strategy, whether you're trading futures or commodities or anything else, trade to learn first. If you immerse yourself in learning, then your ability to trade to earn going forward will come more naturally. Most traders reverse that. They trade to earn because they want to earn quickly. Then they lose because don't really understand completely what they're doing, and then they begrudgingly try to come back and learn what they're supposed to know in order to be successful. So if you trade to learn first and then trade to earn, you will be much more consistently successful. And always before you trade, know how much capital you're willing to risk, know exactly what the entry signals that you're going to use are, and know what strategy you're going to use. Now I'm going to talk about credit spreads, because credit spreads are one of the easiest spread strategies to trade when you're trading options. In fact, it's so easy, it's where most option traders will begin to kind of learn their way through trading options. Very simple directional strategy. The interesting thing about credit spreads is using that one strategy as a foundation, you can also build as a non-directional strategy, which is called an iron condor. And then there is a unique approach to trading iron condors that we teach at Options Moneymaker, which is called the seed iron condor profit strategy, which actually allows you to accelerate profits when compared to a traditional iron condor. Now, although credit spreads are one of the most commonly traded strategies for especially newer traders, because it's relatively simple, a lot of traders fail at trading credit spreads, and there's really no need for that. Generally, it's because they don't really know how to select their strikes. They build insufficient time into their position, and unfortunately, far too many traders are naive about how much risk they have. Probably the most frequent question I am asked from traders, and I've taught literally thousands and thousands of traders. I used to teach live training sessions with as many as 500 people in the room. The most frequent question I ask is, how do I get myself out of the situation I got into? I can't sleep at night. I've got too much risk on. Well, the simple answer is, don't ever put more risk on than you are comfortable with. And when a position moves against you, you won't be losing a lot of sleep. You won't have a lot of anxiety over it. So that is extremely important no matter what type of strategy you trade. But I want to present to you a strategy and approach to using the basis of a credit spread that will also allow you to adjust and flex to shifts in the market. So there are three very simple rules for trading credit spreads. Step number one, these are steps or rules that you can follow. Step number one is, if you're just starting out, studying charts can be a bit overwhelming. It can be a little intimidating to start trying to figure out how to use all the different technical indicators that are available, and there are so many of them out there. So many of them are so good, but you've got to really feel confident with what you're doing and have a core understanding of trading before you get into those. So we suggest that you use a simple chart with nothing more than 2 and 3 standard deviation Bollinger Bands on it. This is a really getting started approach to trading options and choosing the right strikes for your position. You use 30-minute, 60-minute, and daily time periods. And by using the Bollinger Bands, you're going to create what we refer to as a natural forgiveness factor. That's the space between where your stock or index you're trading is currently trading at, the price, and the risk strike that you put on with your credit spread. So you've got a forgiveness factor built in naturally when you use Bollinger Bands. Number two, rule number two, expiration of your spread should be 2 to 4 weeks out. And rule number three, the credit of your spread should be between $1.20 and $1.80 when you start with a 5-point spread. And of course, position size should always be based on your personal risk tolerance and never wanting to overextend your risk. By following these three very, very simple rules, you're constructing positions with a high probability of success. You're basically stacking the deck in your favor. So just to emphasize the 2 and 3 standard deviation Bollinger Bands, I'm showing you a chart here where the blue lines represent the Bollinger Bands. Now, if you're not familiar with Bollinger Bands, the outer lines, the upper and lower outer lines, are a 3 standard deviation value, and the inner lines are a 2 standard deviation value. And the reason we use Bollinger Bands is because they almost act like a pinball game. And if you go back and look historically, well beyond this time period I'm showing you, pull up a 1 year, or 2 year, or 5 year chart, you're going to find that historically the price of indexes and the price of stocks typically moves back and forth between the Bollinger Bands. Now, it doesn't always move in the opposite direction once it hits one band, but you're starting to increase the probability that it's going to do that. And there are some periods of time where it will walk along a lower band or walk along an upper band before it starts to reverse. But this is such a powerful technical tool that it's worth paying attention to when you're getting started. So I'm going to show you a little bit about this when I get into talking about our example credit spread position. So just to make sure everybody's on the same page about what a credit spread is, I'm going to show you an example of trading a credit spread on SPX. Now SPX is the symbol for the S&P 500 cash index. This is not a futures contract. This is not an ETF. We like to trade options on the indexes. So at the time SPX was trading at 21.83, and this was during September week 1. SPX has expiration dates every single week, so it makes it very, very flexible for us. We looked at our charts and we saw that there was a declining bias on the chart, and in order for us to take advantage of that, we wanted to open a call credit spread. Now the reason we open a call spread is because if there's a declining bias on the chart, the value of our calls will decrease if in fact the index moves lower, if the price moves lower. And when we open a call credit spread, we're taking a credit, we're taking a cash credit into our account. So we actually want to take that credit, we want to hold on to it, and we want the value of the spread to then decrease in value so that at some point we can buy back the spread, which would close it out, and pay less than what we took as an original credit. So what we did here is we went out about 2.5, 3 weeks to expiration, and we used a September week 4 expiration. We sold to open a 22.05 call, and that had a 22-point forgiveness factor in it. That's 22-point difference between where the index was trading and what our risk strike was. And we call it the risk strike because we want the price of the index to remain below 22.05. But if it does move up to 22.05, we could still have a profitable position. That's the forgiveness factor. So we sell to open the 22.05, and then we buy to open a 22.10, just 5 points further out of the money. We have 3 weeks to expiration. Because the leg that we're selling to open has a greater value than the leg that we're buying to open, and that's because it's trading closer to the money, the spread that we open results in a net credit of $1.80 into our account. So we have 5 points of spread risk, meaning the maximum amount we can lose is 5 points, and we've taken $1.80 of credit, which means we actually have a true net risk of $3.20 on this trade. So this trade is set up to benefit from a move lower of the index, but because of the forgiveness factor, if it moved up less than 22 points, we also have the potential for a profitable trade. Now just visually, when you look at the Bollinger Bands on this S&P 500 chart, you can see first of all how the price has moved back and forth between the Bollinger Bands, and you can see that our risk strike is at 22.05. Now the reason we place it outside of the Bollinger Bands is because of what I said. We know that the price has a strong tendency to start to reverse when it hits the Bollinger Bands, potentially reverse. And we also know that if the price of the index were to move above the upper 2 or upper 3 standard deviation Bollinger Band, it magnifies the likelihood that the price is going to reverse. Now, I'm saying the likelihood, and I'm conscious of that word because it doesn't guarantee that the price is going to reverse. See, here's a good example over here where the price moved above the 2 standard deviation Bollinger Band. It did retreat a little bit, but then it kept moving higher. And this is why we have some management techniques, which I'm going to be talking about here in just a minute. But the vast majority of time when the price exceeds the upper Bollinger Band, then it's going to move lower. When it exceeds the lower Bollinger Band, it's increasing the likelihood that it's going to move higher. We leverage that in the placement of our risk strike. So when we go out to 2205 for our risk strike and the index is trading at 2183, then we know that the price has to move well above the upper Bollinger Bands in order to get to and put at risk our position. And the more it moves above those Bollinger Bands, the greater the likelihood is that the price is going to reverse. We also know that we could be in trouble on this position, and if we are, we'll use a management technique that we teach in order to address that. Now, credit spreads are also good as non-directional trading strategies, and this is what's called an iron condor when you put both a call credit spread, which has a declining bias, and a put credit spread, which has a rising bias, on at the same time. An iron condor is an excellent strategy in cycling markets. If you go back to that chart just for a minute, look at the number of cycles you have. If you had both a call credit spread and a put credit spread on at the same time, and you've placed your risk strikes outside the upper and lower Bollinger Bands, you have a high probability of being able to actually win on both sides. When the price moves higher, you're going to have a profit on your put credit spread. When the price retreats and moves lower, you're going to have a profit on your call credit spread. So we use the Bollinger Bands as a guide to choose the strikes. One side of our iron condor is always going to have a profit based on the initial move after we open the position. And the other side of our iron condor is going to benefit from the forgiveness factor. So we still build a forgiveness factor into each trade, and that is a factor that's going to help us potentially have a profit on both sides of this iron condor. Now, if you take that iron condor strategy approach and you use a unique approach to it, which is called a seed iron condor profit strategy, and the reason it's called a seed is we're literally planting a seed that then we intend to harvest profits from. But it is a variation of an iron condor that uses the same foundation of a credit spread. So all I'm building here, folks, is a credit spread strategy that's used in different ways. So if you get very, very comfortable with trading credit spreads, you can have maximum flexibility by trading directional bias positions, non-directionally biased positions with the iron condor, and now the iron condor strategy modified that allows us to harvest profits more quickly. So a seed iron condor profit strategy position is constructed using the same rules and guidelines as a traditional iron condor. We're going to use the Bollinger Bands as a guide to choose our risk strikes, and ideally we'd like to be outside the 2 and 3 standard deviation Bollinger Bands on a 60-minute chart. If we can get outside on both the put and the call risk strikes on a daily chart, that is ideal. But we're going to use the Bollinger Bands as our guide. We're going to sell to open a call credit spread, and we're going to sell to open a put credit spread. Then what we do is we harvest profits from one call leg and or one put leg when the index moves. Now I just want to stop here and qualify this and say, in our trading, in the trading that we teach our community of traders, we generally do not day trade these positions. So what we do is we open these positions one day and then we're done for that day, which is why it's great for a casual trader. The next day when the market opens, we look at what profits each of the 4 legs may be presenting. Now generally there will be 2 legs that will be showing a profit, but always there will be at least 1 leg of the 4 legs that will be showing a profit. And what we want to do is to try to grab that profit if we can. What we do is we literally widen the spread. So if we started a credit spread with a 5-point difference between the strikes, and now we widen the spread, we're going to end up with a 10-point difference between the strikes. What we've done is we've widened the spread, we've put a little more capital into the trade, there's a little more risk into the trade, but we've taken a pretty sizable profit out of that position, having only held the trade overnight. And then what we're left with is a 10-point credit spread, either on one side or both sides. We're left with a 10-point credit spread that we have a positive credit on, that then we hold for yet another additional profit. So the whole concept here of the seed iron condor strategy is to be able to accelerate the profit taking and actually improve the opportunity for profit overall, because the profits that we harvest generally on that initial adjustment from a 5-point spread to a 10-point spread are greater than the profits that we would have if we had just held the iron condor until close to expiration. So the seed iron condor profit strategy allows you to adjust to daily directional movements. Now this is a very, very powerful strategy in that regard. You know, the market cycles. When I showed you that chart to emphasize how the price moves back and forth between the Bollinger Bands, those are the cycles. When it moves higher, that's a rising cycle. When it moves lower, that's a declining cycle. Those cycles occur every single day, and they all sit within an overall trending market. It may be trending higher or it may be trending lower, but it's the daily cycles that we really want to try to leverage. This strategy offers profits as soon as the following day, and the cool thing about this is you can adjust between non-directional and directional bias. So let's say you opened a position. I'm going to give you an example of one here in just a minute. Let's say you opened an SIPP position. You've got both a call credit spread and a put credit spread open at the same time. The next day, you take a look at your position and you decide to harvest a profit from one of the call legs, widening the call spread, and then you decide to just close the put spread. What you've done is you've shifted from a non-directional iron condor strategy to a directionally biased, downward bias, a directional strategy. And you would do that just simply based on where the index is trading relative to your Bollinger Bands. If all of a sudden the price has moved higher and it is exceeding the upper Bollinger Bands, we know that there's a high probability that the price will move lower from there. So we want to take our profit on the call spread side, we want to close the put spread side, and we don't want to impede the movement lower. So now we have a directional bias position. If we held just a spread, a call spread or a put spread, and there was a movement opposite our spread, and it wasn't enough for us to close and take a profit, we could add the other side of the spread of the iron condor and shift from a directional bias position into a non-directional bias position. So it's a very, very flexible strategy when you really start to understand the movements and the cycles of the index and how they can play very well with an iron condor. We can use this strategy to manage a position also where a position has become a problem. We can actually, I'm going to take you through an example of this, we can actually navigate our way through a natural rollout or reposition. We can adjust the strikes of our position, we can adjust the expiration of our position all very naturally by layering in an additional seed iron condor position. This strategy, as opposed to a traditional iron condor, is also more responsive to the cycles of the indexes. And in our experience, through all of the testing and validating we did, and creating the rules around this that we wanted to teach to our community, we found that typically it's going to generate between 20 to 25% return on capital at risk. And what you're doing then is you're recycling that capital into new positions once you've closed out. So here's an example of a seed iron condor profit position that was opened on the 14th of October. SPX was trading at 21.35. We opened the position. We opened this put spread, sold to open a put spread that was a 21.10, 21.05. We also sold to open a 21.80, 21.85 call spread. So now we have a rising bias directional position on the puts and a declining bias directional position on the calls, and what we hold is an iron condor. We took a total of $3.10 of credit with $1.44 on the puts, $1.66 on the calls. So it meets our rules of wanting $1.20 to $1.80 of credit. So we have a total of $3.10. On a 5-point spread, you only count 5 points on one side when you have an iron condor, because you cannot possibly be at risk or lose on both sides at the same time. So we have 5 points of spread risk minus $3.10 of credit. We have $1.90 of actual risk on this trade, and we traded 5 contracts of this. Now on the 17th, SPX had dropped down to 21.30. We look at the chart. It was our view that we had a declining bias, and we decided to harvest profits from the short call and close the put spread. So the index has moved down just slightly, but enough for us to take a nice profit on the short call. So what we did is we bought to close the 21.80 call. We bought to close the 21.80 call. That's where our profit was. It was $1.81 a profit. And we sold to open simultaneously the 21.75 call. And we took in a 10.37 credit on that. So we widened the spread from a 5-point spread to a 10-point spread, and then we closed out of the put spread. So we took $1.81 a profit on widening the call spread, and we took a 16-cent loss on closing the put spread. So now we've converted from a neutral bias, neutrally directional bias position to a declining bias position, and we hold $1.81 a profit, 16-cent loss for a net profit of $1.65. So the new position that we hold now is a 21.75, 21.85 call credit spread. We have $1.45 of credit on this spread. As I said, we adjusted from a neutral bias, really no directional bias, to now a declining bias. We already have a profit of 16.5% based on our 10-point gross spread risk. We have 10 points of risk in our spread. So if I don't even factor in the credit that I have on that, and I just have a maximum gross risk of 10 points, I've got a 16.5% return. At this point now, we can be flexible and make decisions based on the cycles as we watch the price of the index move back and forth between the Bollinger Bands. And we can either close the call spread at even based on $1.45 for no additional profit, which would lock in the $1.80 or the $1.65 of profit that we took that's in our bank, or we could open a new put spread if we saw a directionally biased shift in the market to recreate an iron condor again. This is such a flexible strategy, folks. It's great for newer traders in particular. You learn the basic fundamentals of credit spreads, and you can apply it in declining bias, rising bias, or neutral bias markets. And you can shift constantly between those different variations of what the market is telling you. On the 1st of November, the index was trading at 21.30. We closed the 10-point call spread for a profit of 15 cents. We closed it for a debit of $1.30. That was an additional profit of 15 cents. So our original profit was $1.65. We've now closed for additional profit of 15 cents, which means we took a total of $1.80 of profit, and we're completely back to cash. There are two primary objectives when you're trading a seed iron condor or profit strategy. Number one, harvest a profit. Number two, get back to cash as soon as you are able to without giving up the profit that you've already taken. Okay? You want to get your capital back, because what you want to do then is recycle that same capital back into a new 5-point spread and find another $1.80 of profit. So we were in this trade for 13 trading days, 18 calendar days. That's a little longer than we normally hold, but we take what the market offers us. We don't argue with the market because the market will always win. It ended up being a total of $900 of profit, which was $1.80 per share, and we were trading 5 contracts. So if you take a look at what our actual maximum risk is on the whole management of this trade, we had 10 points of spread risk and we had $1.45 of credit on that 10 points. Our maximum risk at any point in time was $8.55. So if you take the $1.80 of profit divided by our maximum risk, it was a 21% return on maximum risk. Now sometimes even with a forgiveness factor, a position needs an adjustment. And the cool thing about the seed iron condor profit strategy is it can also be used as an excellent management technique. Once again, we're just staying right with the same core credit spread strategy and the same variations of iron condors and seed iron condors. We're not starting to deviate into multiple other strategies to help you manage your portfolio of positions. When a credit spread is in the money or approaching expiration, and the perception is, your view is that the position is in trouble, it's either in the money or you're approaching expiration, it looks like the index is moving against your position. What you do is you very simply open a new seed iron condor profit position. You open a new position. The following day you harvest profits, and then you use those profits to close the liability position, the position that you feel is potentially at risk. It's a very simple approach. What we're doing here is we are staging a natural rollout and a natural reposition to a new set of strikes and potentially a new expiration. Adding time and adjusting strikes without a major drawdown. Actually, my slide's wrong. I should say without a major drawdown. Because what you're doing is you're taking profits on your new position. You might actually have a drawdown or a loss on the current position that is stressing you. So you pay off that drawdown or loss. And the way we manage this is we do it in such a way that we retain net positive profits in each of those transactions. So by using this SICP strategy as a management technique, you're able to adjust to changes in market trend very easily. So as an example of this, with SPX trading at 2161, we're holding a January week 1 2145, 2155 call credit spread. Right now, that's completely in the money, and we don't want our credit spreads to be in the money. It's completely surpassed the forgiveness factor that we built into it originally. But the good news is we built time in each of our positions, and this one still has plenty of time. So with $1.39 of credit, but the mark on the position, which is the midpoint between the bid and the ask, is 650, it's not looking very favorable for us. Our options would be to just hold and take no action, because we do have time to expiration. But if we don't take any action and the index continues to move higher or doesn't move back below 2145, that 650 mark, midpoint between bid and ask, is going to grow to $10. And so what we want to do is to take action when we see that we're in trouble on the position. So what our second course of action could be open a new SICP position. We can either use the January week 1, same expiration we currently hold, or we can go further out in order to execute a natural reposition of the strikes as well as a natural rollout. So we decided to open a new position. What we did was we went out one additional week, so we added more time to our position. Time is always our friend. We sold to open a 22.35, 22.30 put spread, and we sold to open a 2300, 2305 call spread. Now, when the index moves, we're going to harvest profits from one of the put legs or one of the call legs or both. That's going to widen the spread from 5 points to 10 points. So let's just say that we widened the call spread here and we closed the put spread for a very, very small loss. Now what we would hold is a 10-point spread on the call side, but we would use the profits, we'd use a portion of the profits, and a portion is critical here, to pay off or pay down the 2145, 2155 liability position. This is a risk to us. But if we harvest profits and are left with a 2300, 2310, for example, what we've done is we've naturally moved the risk strike from 2145 to 2300, and we've added one additional week to expiration. And if we took profits when we harvested and used only a portion of those profits to pay down or pay off the contracts I hold on the 2145-55, it means that we have net positive profits for the day. We've reduced our liability in the money position, and we've naturally moved our risk strike higher up to 2300. And if I didn't pay down all of the contracts, I would pay down a portion of them, and then I would do the same thing again with another additional seed iron condor position. Now, there's going to be a natural question here, I think, about aren't you just laying around more and more capital? Well, the fact that we widened the spread increased the amount of risk we had in capital requirement, but then we're actually decreasing our risk and capital requirement by closing the 2145, 2155. Now this shows you why we placed the strikes where we did, 2300 and 2235. It's because they are well outside the 2 and 3 standard deviation Bollinger Bands on a 60-day, 60-minute chart. So this is a strategy that's designed for our trading community to leverage the cycles based on Bollinger Bands. It's the greatest approach for newer traders because it doesn't take a tremendous amount of time. It keeps things really simple by just staying focused on a single strategy, which is a simple credit spread. You can either trade a credit spread, or you can trade an iron condor by putting 2 credit spreads together, or you can trade a seed iron condor profit strategy by putting 2 credit spreads together and harvesting profits on one side or both sides. You build a forgiveness factor into each trade. That by itself is going to help you be wrong potentially on the placement of your strikes, or flex to a market shift, potentially still be profitable even though the price of the index may move against you. And this really is how to simplify your trading. We do this every single day in multiple accounts, and we work with a large community of traders who are following along with these trades, and we strive not only for the purpose of our own our community of traders, but for ourselves and our own accounts. We strive to keep things just as simple and friendly as possible. The way you're going to grow your account is recycling your capital into new positions over and over and over again. Open one, close that position, take that same capital and put it into a new position. That's how you can grow your account without significant risk. So just some food for thought here. We started a program called the Profit Builder Program in 2015, and we actually started it with the intention of only risking $5,000 of capital. We weren't doing this to make huge money. We were doing this to help our clients, help our community know that they could start with a relatively small amount. We had $11,000 in the account, but we only risked $5,000. So the first year profits were $14,317. Year to date, as of today, year to date, we're up $11,582.91, and we just actually live launched the SICP strategy last week. We've been testing it for a very long time, but the positions that we have traded with our community of traders since we launched the training on the 6th of December, we've traded 5 positions, and we, based on 2 contract trades, so very small trades, we've generated profits of $2,043.09. That's after fees and commissions. So I just wanted to share that with you because what we do is not right for every trader. It's not right for everybody who wants to trade, but I just wanted to show you that we strive to keep it very simple, and I think that this is a very powerful way to start small and potentially grow a big account. Now, if you have an interest in what we're doing, I'm not really selling you here, folks. I'm just sharing with you. It has to be self-selection. What we do has to be something that you're really interested in. So I'm just going to share with you what the opportunity here is. The Seed Iron Condor Profit Strategy training, which was just launched last week, is a 2-session training, 3 hours in each session. They're on demand right now. They're recorded, so you get 6 hours of that. It's just $195 to actually learn that strategy. We're giving you $200 off our regular price of $395. And you also get an on-demand recorded 2-hour Q&A session that followed up. And there are 2 more Q&A sessions that are coming up. One on Tuesday of next week, the 20th at 7 p.m. Eastern, and the next one is Tuesday, January the 10th at 7 p.m. Eastern. So these Q&A sessions are designed so that people can go through the training, learn what they don't really know, and then ask a lot of questions in order to really benefit from the program. Now, if you are a confident trader, if you really know what you're doing and you don't mind introducing yourself to a new strategy and understanding it through the Q&A sessions, that's great. All you would really need is the SICP at $195. We do provide, because we've been asked to provide by our community, additional month-to-month support, ongoing everyday support actually through our Profit Builder program. So for $129.95 a month, in addition to the $195 one-time fee, you can access our SICP live trading room the first hour of each market day, where we are going through and harvesting profits and showing you exactly step-by-step how to do that, and then we're done. It's not an all-day session, because we do have an all-day live trading room separate from that, but it's not an all-day session because we really are focused on people who want to trade more casually and have busy lives doing other things. But that $129.95 per month also gets you a about a half-hour daily position review for ongoing education. We actually record an analysis of the market, what the indexes are doing, what each of our positions are doing, and our thought process on each position. We also send you a trade alert each time we open, closed, or harvest a profit from a position. So if you're not looking over our shoulder in the live trading room, you still get a trade alert. And you also get 4 hours of on-demand training on credit spreads and iron condors with that Profit Builder program. And in addition to all of that, you get a PDF that you can download, which is Trader's Guide to Option Basics, as well as a Trader's Guide to Credit Spreads. So the SICP plus the Profit Builder is, in my opinion, an excellent education package, and frankly, at the prices that we offer, we like to do what we do. We are in business to make money, but I have a team of traders, and we've been all trading for many years, and we just enjoy helping people learn what it took us a lot of years to learn the hard way. So you can sign up for the $195 and just learn the Seed Iron Condor strategy if you want, or you can sign up for that plus the support. These are the links. If you want full support, it's optionsmoneymaker.com/full support. If you just want the seed iron condor strategy, it's optionsmoneymaker.com/seed-iron-condor. So again, self-select. I mean, if what I'm sharing with you makes sense, if you're interested, you can also browse around our website. This $129.95 per month is not yet on our website, so you've got to use this particular link to get there. And I'm going to take a look and see if there are any questions, if I still have time. And if I don't get to a question that you might have had, please feel free to email me directly, mark@optionsmoneymaker.com.